Hi, I wanted to go over our session on interest rate risk, session two, starting now. I wanted to go over one with interest rate risk. We have, on one hand, I wanted to go over the PowerPoint that goes over the idea of interest rate risk. And the whole idea is matching up your assets and liabilities, and the way I would imagine it first, the whole interest rate risk is, imagine you're living off fixed income and you have a mortgage to pay, so you have to make sure that whatever you're getting from your assets is enough to cover the interest and mortgage payment on your liabilities. And that's what banks do on a bigger scale. Their assets are going to be coming from their savings, that they're basically have that as an asset, or actually the asset would be the loans that they have given out to borrowers, and their liabilities would be individual savings that are deposits. So that's a liability. So whatever they pay out on their deposits is the liability. Whatever they are collecting on their loans is the assets. So the whole idea of the repricing gap is looking at how much more liabilities you have than assets, and then applying the interest rate risk. And you have to do that by maturity. So you match up the loans that are short term with the deposits that are short term, the loans that are medium term with the deposits that are medium term, and so forth for the long term. And then you figure out what's the gap, what's the difference, and what's the rate. And that's basically the repricing gap. Should the interest rates change, of course you're going to be affected for that asset slash liability. And that's something that you can compute by just taking the difference times the situation that you're working with here, which is the delta times the rate. Now, what is going to happen with this? I wanted to circle back to this in a moment, as there's an example here that you will go through. But at the moment, looking at this graph, this whole idea of interest rate risks has been kind of more of a science, because the rates are currently so low that there's hardly any interest rate risk out there. So just to come back to that, I want to make a point of this, because right now the relevant situation is why isn't there any interest rate risk out there on the books? Because rates have been at zero and going nowhere, which is very, very peculiar. So I just looked this up. It's a very interesting question, actually. So I will have you read this. This may be our discussion as well, actually, for the week. And I encourage you to read the text and the PowerPoint. And I also encourage you just as much to go over this question: is why are interest rates so low? And as you see, this phenomena started immediately after the financial crisis and has been persistent now. We're looking at, we're almost in 2018, so we're looking at, I believe, 8 years. 09, 1, 2, 3, 4, 5, 6, 7. So it's 8 years at least. Plus '08 was a turbulent year. So it's almost 9 years. I would say 8.5 years. We're going almost on a decade. This is a huge trend. And let me just go back to this paper here by Ben Bernanke. And this really talks about why are interest rates so low. And the idea is, as I actually thought myself, it's not so much that the Fed is controlling it, it's more of a global phenomenon. And what does that mean? The rates are low in Germany, in Japan, and the United Kingdom. And what he goes on to say is that it's not because the central banks are holding the rates low, it's more so that the idea is that the Fed matches the real interest rate that is the equilibrium out there in the market. And that is the total interest rate less inflation, which is called the real interest rate. And that rate has been very low globally. And what does the real rate really reflect? As a very old school economic kind of explanation over here in these two paragraphs, he talks about the idea that this is really a supply demand, the equilibrium real interest rate. And this is something that I want you guys to look at as you guys look at this. This is basically the supply demand of capital and projects. And this is called the Wixelian interest rate. It comes from the economist from the late 19th century here. And the idea is that in a rapidly growing economy, these rates would be high as there's high prospective returns on projects. There would be a high demand on capital, not enough capital. And because of that, rates would be high, right? But in a slowly growing or recessionary economy, the equilibrium of the real rate is likely to be low, since investment opportunities are limited and relatively unprofitable. So right now, that's where we are, right? So that's basically, the idea is that we're in the low rate economy. And I don't think that there's no profitable projects out there. It may be just that there's so much money out there that there's more capital out there for investment purposes than there are profitable projects. And everybody has to put that capital somewhere. And as a result of that, we're having a strain on interest rates. Now, this is something that I want to focus on. Now, if the Fed was to raise the rates anyway, then he's saying here, Ben Bernanke used to be the chairman of the Fed, is saying that, it could backfire because if you raise your rate above the equilibrium rate, it would actually just slow down the economy because that's not the real rate. The real rate is what it is. So you're going to have an artificial high rate, which would actually make projects more expensive than they are. And, since people will be paying more than they need to, it would actually be an expense that would burden the economy. So something to think about, guys. Please go through this. I'll comment again on how we can create a research on why rates are so low. And please make your postings and in the discussion, and we'll go over all together, and I'll be uploading more material in regarding to this.